You can't have remember this, you can't have a healthy economy or a healthy country, a healthy nation without a healthy and vibrant middle class. And we no longer have that in this country. Inflation has already bankrupted the nation. The middle class is eviscerated. So 78% of Americans are living paycheck to paycheck. 50% have negative net worth. It means prices are already unaffordable. So that's the problem that I see right now. So if rates don't come down, across the yield curve, relatively quickly, the economy's in for a big trouble.
Many Americans have come to feel that a middle-class lifestyle is out of reach. Blame inflation for bringing down the mood and making the economy seem much worse than it is. Michael Pento, president and founder of Pento Portfolio Strategies, provides insight into the present economic landscape and looming risks. He draws attention to the escalating inflation rate, emphasizing its impact on the middle class and the broader economy. Additionally, Pento underscores the unsustainable levels of debt burdening households and financial institutions alike. A growing number of middle-class families are struggling to afford the basics of housing, childcare, food, transportation, and healthcare. Many in America's middle class feel less prosperous than in past generations. Many are also dipping into their savings, making retirement feel uncertain. For many in the middle class, inflation is at the heart of this feeling. In the Northwestern Mutual Survey, 51% of respondents said inflation was the biggest obstacle to financial security, while 67% of households in Primerica's survey said their income was falling behind the cost of living. With mortgage rates hovering close to a 23-year high and home prices near record levels, Americans need to earn 80% more than they did before the pandemic to comfortably afford a home, a recent Zillow report found. Despite these concerning trends, the Federal Reserve seems content with a 3.5% inflation rate, failing to acknowledge the existing economic strain. Pento emphasizes that while the rate of inflation may be slowing, it remains alarmingly high given the already precarious financial situation for many households. After inflation, Americans' personal debt levels continue to grow. That is tracked by the most recent data from the New York Federal Reserve, which shows that credit card debt accounted for a record-breaking $1.13 trillion of the overall U.S. household debt, which reached $17.5 trillion in the last quarter of 2023. According to Pento, this escalation in debt, combined with indications of insolvency within the banking sector, paints a troubling picture of the economy's health. Now, let's break down what this all means, of course, with Michael Pento.
Inflation is rising at 3.5% annual rate, year-over-year change. And I guess he's doing victory laps on that, but it came down from 9% to 3.5%. But inflation is already bankrupted the nation. The middle class is eviscerated. So 78% of Americans are living paycheck to paycheck. 50% have negative net worth. And, so let's just take an example. Home prices are up 50%. This is not my opinion. This is the data from Schiller. 50% since COVID, 2020. So, home prices are unaffordable. A basket of food is up 37%. So people can't afford to eat. People can't afford to buy a house. The real estate transaction market is frozen. And yet the Fed is taking victory laps at 3.5% inflation. So in the second derivative sense, inflation is rising at a slower rate than 9%, but it's rising at 3.5%, which is much higher than 2%, which is their goal. But more importantly, inflation is higher, is rising from a rate that has already bankrupted the middle class of the country. It means prices are already unaffordable. So that's the problem that I see right now. And that's why you look at all these earnings reports. There's from Expedia to Booking.com to Starbucks to McDonald's to Walmart. They're all saying the same thing. The consumer is under a lot of pressure. So what we're doing here, Julie, is we're recycling the debt, which is through the roof, consumer debt. It's just like household debt. It's $20 trillion. It's up from $15.6 trillion just 2 years ago. So the nominal amount of debt is through the roof. The U.S. economy is insolvent. Banks are insolvent. The regional banking index will prove that beyond a shadow of a doubt. It was bailed out by the Bank Term Funding Program. But Banks' assets are underwater, mortgage-backed securities or treasury holdings are all underwater. The U.S. government is insolvent. We're cycling rates at much higher rates than they were, when the U.S. Treasury was 0.33%. Now the U.S. Treasury is what? Is a 4.6, 4.7% on a 10-year duration. So 20% of the listed companies in the United States are zombies. 40% of the Russell 2000 companies are zombies. Don't make any money at all. So we're cycling the economy through these interest rates that are much higher, and though up my portfolio, I manage money for a living. Right now, we are not net short in the portfolio. If rates aren't able to come down quickly, and I mean interest rates both on the long end and in the short end, so it's not a monolithic term structure here. Interest rates there's duration. So short-term rates, the Fed controls. Long-term rates, they do not. So if rates all come down, across the yield curve, relatively quickly, the economy's in for a big trouble.
The U.S. economy experienced slower than expected growth in the first quarter of this year, while inflation accelerated, potentially postponing a cut in interest rates. Official data revealed that the economy expanded at an annualized rate of 1.6%, falling significantly short of both forecasts and the growth observed in the final months of 2023. Amidst this economic backdrop, NVIDIA's remarkable 178% surge in stock value has stood out as a highlight of the U.S. equity market rally, with investors banking on the chipmaker's potential as a major beneficiary of the artificial intelligence boom. Additionally, the housing crisis has impacted different areas of the U.S. unevenly, with some cities being undervalued while others are deemed overvalued. According to Michael Pento, the market is massively overvalued, not just by a small margin. He asserts that if inflation cannot be brought under control without causing harm to the economy and bursting asset bubbles, significant reductions in home and stock prices may be necessary. Let's shift our focus to a video.
The market is massive, and not just by a little bit, it's massively overvalued. And if you can't bring inflation under control without killing the economy and bursting asset bubbles, which my calculation, home prices have to be reduced by 40%, and coincidentally, the S&P 500 has to contract by 40%. 40% on both home prices and stock prices to bring them back to historical means. The relationship between total market cap of equities to GDP and median home price to median family incomes. So if that happens, you'd bankrupt the entire banking system. There wouldn't be a pension plan that would be solvent in this country. So if you can't do that, then my thought process goes like this. So if you have to inflate, if you have to then bring the Fed's balance sheet, which was once $700 billion in 2007, and then it went to $9 trillion, you got back down to $7.4 trillion, and you're dramatically cutting the pace of QT now, more than they even anticipated, verbal telegraph. And what happens if this balance sheet goes to 10 trillion and 20 trillion and 30 trillion? What happens to the value of the dollar? What happens to inflation? I think we could be setting ourselves up for a period of intractable stagflation, the likes of which we have never before seen in this country. He will cut interest rates back towards zero. He will re-engage in QE. He will relaunch the bank term funding program. And there'll be a plethora of alphabet soup of all of these programs. Helicopter money, I'm sure him and Janet Yellen will kiss and make up. And he'll be monetizing trillions of dollars in treasury debt. But here's the thing. And again, I want to make this point very clear. So the deficit right now is around $2 trillion, $1 trillion in interest. Deficits will blow up to around $6 trillion. If it's like the 2000, 2008 recessions, deficits double. Right, deficits triple, sorry. So they go up by 200%. So you're looking at a $6 trillion deficit, most likely, in this country. $6 trillion. Interest rates would skyrocket if left to market forces. They're just not the savings to supply that. So the Fed's going to have to monetize that debt again. And what is the duration response, the long-term response to treasury prices and yields, if that is indeed the case? Because either the supply is going to get you or the inflation is going to get you.
The number of Americans naming inflation or the high cost of living as the most pressing financial problem facing their family reached a record high for the third year in a row. High inflation places added financial strain upon marriages and families, especially those already struggling to make ends meet. Wondering when inflation will go down? We're optimistic about what's ahead. We value your thoughts, so feel free to share them in the comments.